Good afternoon, this is Sean Golding with Golding & Golding, here to jump into 2025 FBAR filing requirements. This is regarding the 2024 FBAR that's due to be filed in 2025. So let's jump into it. So first things first, what is the FBAR? The FBAR is for foreign bank and financial account reporting. The idea is it's used to report foreign bank and financial accounts to FinCEN, the government agency. It's not submitted directly to the IRS like your tax return is or the Form 8938, but the IRS has been tasked with enforcement, and they've been pretty aggressive over the past 10 to 20 years. Some types of accounts that are reportable for FBAR include bank accounts, your savings account, your checking account, NRO, NRE, current account, things like that, investment accounts like stock accounts, mutual fund accounts, ETF accounts, unit trust accounts, things like that. Pension plans, a superannuation from Australia, CPF from Singapore, MPF from Hong Kong, etc., etc. It's all reportable. Canadian RRSPs and RIFs. And then life insurance. Not all life insurance, primarily just life insurance when it has a surrender value or a cash value. In other words, there's a value to it. You've been paying premiums. You go, you know what, I don't want this anymore. And you go in and you can cash it out or surrender it. A few important things to know about FBAR reporting. The most important is the threshold, right? Because if you don't meet the threshold, then you don't have to file. But unfortunately, the threshold is pretty low and it hasn't really adjusted for inflation. It's more than $10,000. So if on any day of the year, the taxpayer has more than $10,000 in foreign accounts, they have to report it on the FBAR. One of the most important things to keep in mind is that it's not $10,000 per account. It's $10,000 in annual aggregate total. You could have one account with $40,000. You can have 10 accounts with $1,500. If the total value of the accounts exceed $10,000, then you report. If you have a joint account, you still include the total value of the account. Okay. Another important thing to keep in mind: you're not reporting the total amount of money that you have. You're reporting the maximum account values in the accounts that you have ownership, co-ownership, or signature authority, so double counting and all of that kind of jazz is common. Technically, the FBAR is due on April 15th along with the tax return, but it's an automatic extension to October. Automatic extension means that you automatically get the extension. You don't have to file anything. You don't have to file the 4868 or 7004. It's on extension to October. A very important question is, what do you do if you don't have to file a tax return? Well, unfortunately, you still have to file the FBAR. There's no rule that says if you don't have to file the tax return, then you don't have to file the FBAR. The way it goes is like this. FBAR is required by U.S. persons. So if you're a U.S. person for tax purposes, you have to file the FBAR. Even if you were to make an election to be treated as a non-resident alien, the IRS takes the position, you still have to file it. There was a recent case called ROS Day where the court said no dice. If you make the treaty election, he was in Mexico, treaty election to be treated as a non-resident alien, you can't force that individual to have to file the FBAR. Let's go over some additional facts that's kind of common, not as common, but still important when it comes to FBAR reporting. Okay, so first thing, joint account with a non-U.S. person. If there's a joint account with a non-U.S. person, two key facts. One, you still have to report it. Doesn't matter that it's a non-U.S. person. And you have to report the maximum balance of the account, not the maximum balance of your ownership percentage. You don't actually have to have ownership of the account in order to have to report it. People who have signature authority are required to do it as well. Now, this is different than Form 8938, which is similar to the FBAR. And you might see that Form 8938, the same as FATCA, the Foreign Account Tax Compliance Act. For that, you need financial interest in the account. So just having mere signature authority, no financial interest would mean you don't have to include that account. But for the FBAR, it's either ownership, co-ownership, or signature authority. If you close the account in the current year, you still have to file. So I get a lot of these questions like, hey, we just learned about it. This blows. Like, we're just going to close all the accounts now in 2025. Well, even if you close it in 2025, it was still opened in 2020. It was still open in 2025, which means in 2026, when you'll have to file an FBAR to include any account you closed in 2025 because the account was still open in 2025. And closing it could cause other issues too, especially If you haven't filed in prior years, we'll get to in a moment, and you got to get that information. You close the account. The foreign financial institution is probably not going to give you that information readily. So what happens if you're out of compliance? Well, if you're out of compliance, there's various programs available to you to get into compliance. If you're willful, you knew, willful blindness, reckless disregard, you would do the voluntary disclosure program. But despite all the fear-mongering you will find out there, most of the time taxpayers are non-willful. Not always, but most of the time. And if you're non-willful, there's lots of other programs available. There's the streamlined procedures, the delinquency procedures, and reasonable cause. The penalty range varies depending on which program you qualify for and if reasonable cause is accepted. We have a ton of free information available on our main website and our sub-website. You can always reach out and schedule a reduced fee initial consultation if it's appropriate to your matter, and it's something that we handle here. Again, my name is Sean Golding with Golding & Golding. Thank you for your time. Enjoy the rest of your day.